For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Randy and Jake Floyd of Floyd Financial Group will be your guides for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Good morning. Thank you so much. Welcome to Show Me the Money, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about whether or not you know if you can retire this year. That's a good question. Also, the June retirement move smart retirees are making right now. We'll talk about how 2026 retirement rule changes have shifted your savings. And finally, a multi-year guaranteed annuity, a CD, mutual fund, money market funds, which belong in your portfolio. My name's Jeff Shade. I'm just here to ask the questions. But of course, the words of wisdom and solid advice, they come from Randy and Jake Floyd, Floyd Financial Group. Hey, Randy, how you doing today?
Doing very well, Jeff. How about you?
I am fantastic now that we're together again on the radio. And Jake, how is this Saturday finding you?
I'm doing great, Jeff. Thanks for asking.
Always glad to hear it, my good friends. I hope our listeners here in the last bastion of sanity are having a great weekend. We always really appreciate you joining us here for Show Me the Money. Randy, this may be one of the most common questions that people ask as they get closer to retirement. Can I retire this year? Well, what is your answer to that question, Randy?
Well, the first thing I say is, well, that depends.
It always depends.
That's right. So most people think retirement comes down to hitting a certain dollar amount, or there's a magic number out there somewhere that, in fact, the old commercial from a company called ING, which is now known as Voya, used to say, what's your number? And had the little squirrels running around the TV carrying numbers, if you remember that. In reality, retirement's much more than a number. It's about your income, your expenses, your taxes, your health care, what you want to do, your lifestyle goals. All those things come into play there. And when people come in, a lot of times they're closer to retirement than they think. And once in a while, I remember Jake and I had one here. It's been a while back where we said, listen, you can't afford to keep working.
Right.
You got to stop now. And then many times people are focused on one thing. That's the money side of it. And they haven't really considered all the other aspects.
Right. The financial side of it is one thing. And I think when most people ask that question, that's what they're really asking. Do I have enough money to retire? But as you said, it's more than just about financial. Have you had discussions with people about what the non-financial side of retirement is like and whether or not they're ready to make that change?
Yeah, I had about 3 of those yesterday.
Really?
Yeah, so every time, that's the conversation. And for most people, they retire one time in a lifetime, and we help people retire every day around here, literally every day. And so we've done this many, many times. And so the considerations are, what's my health? Is my spouse, are we the same age or close to the same age, or do we have a gap in there? Sometimes the healthcare side of things can be a big problem for people. If we have people that are maybe 3 or 4 or 5 years different in age, one turns 65, gets Medicare, hooray, and the other one has to figure out how to buy health insurance if they're going to retire, which can be very expensive. So there's just a lot of different things to think about. What is my budget? What are we actually spending? When was the last time we actually thought about money? After we've raised our family and paid off all of our debt, maybe we own our house outright, we're making more money we've ever made before. A lot of people don't have a budget, and it's something we have to think about because all of a sudden now, as my sister says, we're on a fixed income.
And that fixed income could be pretty healthy, and you wouldn't have to necessarily worry about that. Yeah, we've run into people who, they're on a fixed income of 50 or 20,000, and they're worried about that. Usually not the case, though. So where should someone start if they're seriously thinking about retiring this year, Randy?
The first thing is to come in, let's sit down, let's figure out, through our process, we always want to know, first and foremost, where are people in life? What do they want to accomplish? What do they see retirement as being? And really start to look at, is it a reality that we're ready to do that? Not only from a monetary standpoint, but from health and sometimes even emotionally. My brother-in-law was one that had a really hard time when he retired. His work was his total identity. He had nothing else to turn to.
Yeah, Randy, and we had this discussion before we went on the air today that retirement is not necessarily the end of life. It is the beginning of a new chapter of life, and it's unfortunate that many people do not plan for that second act in life, as a friend of mine, Dr. Richard Himmer, who's written the book called The Encore Years, illustrates there.
Again, it really does boil down to cash flow because nobody can retire with no money, right?
Yeah, well, that's
we
right.
have to pay our bills, and it's amazing to look sometimes at how much money people have saved and how they've saved it, and they haven't really considered or thought about what does that really mean for me as far as a retirement income. They kind of know what Social Security looks like as far as what it's going to pay them each month, but they really don't know, looking back over their shoulder, how much they've contributed to Social Security, kind of like what they've done into their IRA. But it's really hard sometimes for people to grasp, what does that IRA balance really mean to me in sustainable lifetime income? So that's one of the first things we have to consider.
Right. Take a look at the IRA, what the balance is. Then the next thing is, how do we turn this balance into a monthly, bi-weekly, or a weekly paycheck? How do you go about doing that? Can you really figure out how much somebody's going to get on a monthly basis?
We can. We have to really take all of the base of knowledge that we've developed over the years, look at all the different asset classes that are out there. From some people have rental properties, it could be CDs, it could be bonds, it could be stocks, it could be annuities that are out there, it could be gold. For some people, precious metal is really important. There's just a lot of ways and a lot of different methods that people try to build a retirement income. The first thing we want to do is really make sure that you're going to have enough money to keep, as I say, the wolf away from the door and pay all the monthly bills. And then I want to know next, what do you want as far as lifestyle money to spend? Because let's face it, just going home and twiddling our thumbs and eating our part of the food every morning, drinking our coffee on the back porch may not be all we want to do.
That's right. We're talking with Randy Floyd and Jake Floyd here at Floyd Financial Group, and we're answering the question, can I retire this year? A lot of things to think about. If you are asking that same question, you'd like to sit down with Randy or Jake here at Floyd Financial Group and maybe talk about it a little bit. 417-889-7233 is our telephone number. You can make that call right now if you want and request your Floyd Financial Group retirement review. We'll talk about whether or not you can retire this year. Once again, 417-889-7233. There is no cost, no obligation. There is no judgment. We'll meet you where you are. Randy, a lot of people ask that question, can I retire this year? And then you come back with them, not necessarily with an answer, but another question. What is that question?
Yeah, so the question is basically, all right, what do you plan to do during retirement? And what is that going to cost us is the first thing we need to know, right? Because we have different guaranteed incomes. We would call them that today. Some people are still lucky enough, about maybe 15 or 16% of the public has a pension plan they're going to get. And then also we're going to get Social Security. So sometimes combining those two for people, if you're lucky enough to have the pension and Social Security, that can fund your basic needs. And then we look to the 401k and those investments, the IRAs and that sort of thing, to round out what we want for our lifestyle spending. So that's really the first place to start, is to look at all those different facets and make sure that when you retire, it's not going to be retired to nothing, but to something, right?
That's exactly right. And Randy, we were talking off the air about some clients that you have had, and they'll ask that question and you've given them the answer, well, you can't afford to not retire right now. What was the circumstance that you had that statement?
Well, they had pension plans, they had large Social Security checks, and they were actually, with the work they were doing, they were putting themselves into a huge tax bracket. It just didn't make sense for them because they were thinking about retiring, and they were just to the point to where they could do it easily. Sometimes that happens that way when people don't have children. They've been single their whole life, or maybe they've been married, but they were blessed with children, and they really don't have anybody to leave the money to, and they've just got this big pile of money over there because maybe they didn't have to pay for college and all those things.
Right.
So it's just one of those things where sometimes they'd be better off just to go enjoy life.
Randy, recently, certainly we have had a very strong stock market, and a lot of people worry about retiring right before a market downturn. Now, I know that Sir Isaac Newton was under the tree, the apple fell, and he discovered that what goes up many times must come down, and it is the same with the market. Many people, as I said, worry about the market going down. Is that a legitimate concern if you were to retire this year?
It absolutely is, because one of the things we cannot control. Now, I know you can.
Yeah, I can control
most
the
of
market.
us cannot control the market. So we have to worry about this thing called sequence of returns risk. And it's a real thing. I mean, we've talked about Mr. Brown and Mr. Green many times, starting with the same amount of money, taking the same withdrawals, but just based on who's blocking the Strait of Hormuz or whatever it may be, things that you cannot control come into the picture. That's why it's very important that you have a plan for those times, to know that you have some money that you can rely upon, maybe where you're not spending out of a depreciated dollar during a market downturn, to have some money where we could actually tap that when we need to while we allow those markets to come back and grow back again. And here's the thing. People say, well, how do we know the market will grow back? The market is business. There's 8 billion of us on the planet. Business will get done one way or another. And so it just is a matter of having somebody that helps you develop a plan and then helps you stay and stick with the plan and makes those moves. It's not a one-time set it and forget it. It's something we have to review all the time and make sure we're on the cutting edge of what's going on and trying to make either proactive decisions or put in countermeasures that are going to protect us from things.
Randy, a lot of people postpone retirement because of healthcare expenses, and I know that we talked about that. They're waiting until Medicare comes, and Medicare is a great program. It does cover a lot of things, but Medicare does not cover everything. So let's talk about some of the things that Medicare does not cover and things that we have to plan to pay for out of our own pocket.
So Medicare was basically designed to be health insurance for those people that are either disabled prior to age 65 or hit age 65 and you go on the Medicare program. And basically it was designed to take care of things that we're going to get better from. Okay, so it was not designed to pay for long-term care. Now, some of the plans out there will pay, well, all of them will pay somewhere between 20 and 100 days for long-term care. But beyond that, you're going to have another method of planning. But Medicare basically helps with things like prescription drug costs, and the Advantage plans give you vision and hearing. Some of the supplements aren't as good about that, but going to the hospital, having surgeries, outpatient or inpatient, all those things are what it's designed to do. Basically things you're going to get over and get better from. It'll pay for rehab if you've had a situation where you've broken a hip and you're going to get better and you need 20 or 30 days of rehabilitative therapy in a nursing home, that sort of thing. But long-term care, it is not going to take care of.
Randy, let's talk about taxes. I think a lot of people think that when I retire, my tax rate is going to go down a great deal. Is that always the case?
It's not always the case. However, I will say whether your taxes go down or your rate goes down or not isn't really the point. I think the point is, are we managing effectively our tax strategy and our tax rate? Maybe it doesn't go down. Maybe it goes up. Maybe you're one of those people that you got a huge IRA and boy, when you have to start tapping that thing, it's big. Have we had a strategy in place that's helped us to mitigate taxes looking forward is the biggest thing, rather than what's my bracket and is it going to go up? That's important, yes, but I think it's more important that we have a tax plan.
Randy, what do you tell someone who says, I think I'm ready, but boy, I'm really afraid of making the wrong decision?
Yeah, I mean, I think that is kind of the normal approach to retirement for most people because, again, they come in and they sit down and they're realizing now that a couple things. That number one, I'm going to have to rely upon my savings and things now to produce the income. And they really haven't ever really gotten underneath that to really think about it in the terms we're going to present. And I think that the important part is we're going to sit down and get to know what's important to them, what they're trying to accomplish, and look at what they have to work with, work on a plan with them to where it makes sense to them, and they get to a point to where they feel comfortable with it. And then from there, we just monitor and tweak the plan as we go along. And that's how we get people most times comfortable with retiring. It's not one magic word that we say. It's a process of learning and them developing a confidence in a plan that we've laid out.
Randy, great conversation, but I want to talk to the fine citizens here of the last bastion of sanity, Springfield. Folks, if you've been asking yourself, can I retire this year? Don't spend another year wondering. The answer isn't found in a headline, a social media post, or something your neighbor told you over coffee at the diner. The answer is found in a written retirement plan built around your income, your savings, your taxes, and your goals. Randy and Jake and the team here at Floyd Financial Group can help you determine whether you're truly ready to retire and whether your money is prepared to support the retirement that you've worked so hard to achieve. Call us here at Floyd Financial Group today at 417-889-7233 and schedule your complimentary Floyd Financial Group retirement review. No cost, no obligation, no judgment. It's 417-889-7233. Hopefully, you only retire once, so let's make sure that you get that decision right. Randy and Jake, time for a break. When we come back here on Show Me the Money, we're going to be talking about the June retirement moves that smart retirees are making right now when our program continues here on 104.1 FM, KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Randy and Jake Floyd, with Jeff Shade,
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to talk about June retirement moves smart retirees are making right now.
All right, Randy, you know, we're halfway through the year already. A lot of people made financial resolutions back in January, but life happens. So why is June such an important checkpoint for retirement planning, do you think?
Yeah, here's what I would say, Jeff. I think for the most part, most of our people, we're seeing them every 6 months. So are we seeing them in January and June? Well, I couldn't stack that many people up in the office. There's too many now.
You'd be stacking them like cordwood out here.
That's right, we would. So anyway, we're having reviews with people on a regular basis. Most people about every 6 months. Some that have been with us a very long time, it's once a year. But they know that they have contact with us with a phone call anytime, and they can come in anytime that they want to. And if they got a decision that's looming or somebody gets sick or all the things that happen, they know they can call us anytime. But halfway through the year is probably a pretty good time, like you said, to look and see kind of what's happened. Let's reflect on where we've been the last 6 months and what do things look like looking forward. So again, we're not looking to totally turn over the apple cart. We're just looking for a few wormholes in the apple bin, so to speak.
And avoid those. Let's throw out the ones that got the wormholes in them and get some good ones in there.
So an interesting tidbit here, being a former apple farmer.
Oh, that's right. You were an apple farmer. I forgot about that. Years ago in Washington State for a little bit.
The worm in the apple is actually called the codling moth.
I did not know that.
That's the egg. That's what lays in there, and that's what that worm eventually becomes. So anyway, just an interesting point there about the apple.
Okay.
But anyway, small changes today can prevent big problems later. And one of the things we're going to talk about here in just a moment is what do we do and how do we do and why do we do it?
Exactly right. Well, the good news is that you still have 6 months left to make these adjustments. One of the first things that experts recommend, Randy, is reviewing your investment portfolio. When people do that here midway through the year, what are we really looking for here?
So something that we're looking for all the time is how is a portfolio acting and growing? Now, there's 11 market sectors. Okay, so it's like finance and energy and utilities and technology and consumer staples like Procter & Gamble stuff, toothpaste and shaving cream. Consumer discretionary stuff, that's airline tickets, hotels, travel, that sort of thing. All these different sectors of the market grow at different rates. And they also, you may have heard this term, and most people, I think, would have heard it and thought, what in the world is that? This thing called sector rotation.
Yeah.
So they're talking about the different market sectors. Certain sectors will grow and outpace certain sectors, and they get overbought. They get priced too high. And so we're always watching to see, all right, maybe it's time to trim that, and let's look at a place that's maybe underbought and oversold that's a better value. Let's realize our gain, and let's repark this money. So rebalancing a portfolio is what we're talking about there. And it's been said it's kind of like a tune-up for your retirement plan. So it's kind of like your car. Used to, you had to replace spark plugs. Do we even do that anymore?
I don't think we do. You and I are old enough that, you know, a car got to be 60,000 miles. You've replaced the spark plugs 10 times. It's on its last legs. But these days, I think these plugs, I mean, they'll last 150,000 miles.
Cars used to have these things called points.
That's right.
Remember
the plugs, points, and the condenser. Yeah, I've still got one that takes that, but I replaced the points with what's called a Protronix electronic ignition. We're talking
That's right.
some
And
tech stock.
What is the correct ignition timing for a 327 and a 1963?
We're getting off on a tangent, but it is fun. I still have one of those tune-up things with the dwell meter and all that stuff in my garage.
Wow.
I can't let that go. Carburetors and all that too. Boy, that was a lot of fun back in the day. But anyway, you mentioned rebalancing. What's the difference between rebalancing and reallocating?
So, yeah, that's a good question. So when you look at rebalancing, you're sitting here going, okay, so here's the marketplace and here's how we're invested today. But over time, the portfolio changes and certain areas grow faster than others. Well, a rebalance is, okay, let's go back and let's shift that stuff back to our original portfolio. So that's a rebalancing act. Reallocation may be things have changed. Like I will tell you, in the last 10 years, a rebalancing act has been, wow, technology has gained 15% of market share in general, right? So if we're reallocating versus rebalancing is putting it back in balance the way we wanted it. But reallocation is based on, hey, what's happening here and what's going on needs us to allocate differently.
Or maybe you have a small IPO coming out like SpaceX.
Yeah, just a little one.
So that would be another reason for reallocation, because you need to look at your portfolio as a whole and make sure that it's still balanced, it's still diversified. When you add a company like that or a group of companies or an ETF, you want to look at the thing after you make the addition and go, okay, is this still balanced? Are we still taking too much risk? Are we too invested in one sector? How does all that affect us?
It's kind of like Tombstone. Remember the movie Tombstone?
Oh, yeah, yeah.
Kurt Russell was the star, but Val Kilmer was his supporting actor and made the show.
Yeah.
I don't know. I think that's actually an imbalanced portfolio because Val Kilmer definitely took that movie over and would not have been anywhere near the movie it was without Val Kilmer.
Yeah, so that was diversification, putting him in there, right?
Yeah, more diversification among actors.
Yeah, I like that. Diversification, reallocation here. Talking with Randy and Jake Floyd Financial Group. We're talking about our June 6-month retirement review. Our phone number, 417-889-7233. It's 417-889-7233. If you'd like to come and sit down with Randy and Jake here, Floyd Financial Group, talk about your halfway point checkup on your retirement plans. Randy, what about retirement savings? Is June here, mid-year, a good time to see whether you're putting enough money away, and are most people actually doing that?
Well, here's what I would say. I would say that any time is a good time to look and see if you're putting enough away.
I do it like every week.
And that's what we do at the annual reviews is we are looking to see where people are, what's going on, and ask them questions about where they are in the cycle of getting to retirement, making sure that we're taking advantage of all the employer, what they're going to put in, make sure we're always covering that. But after you're age 50, I mean, you can put up to $32,500 a year into your 401k plans. And after age 62, you can now do $35,000 and change per year. Now, I'm not saying everybody can or would even want to do that. But here's the thing. If you have paid off your house and you've got all your student loans paid off and you got some extra money and you're in a big tax bracket, man, why not? Save the money and let the government fund part of your retirement for you. And I had a lady yesterday talked about the fact that she had already for this year, she had a big bonus. I mean, tens of thousands that she knew was coming. And I said, well, you might want to consider, since you're over age 50, funding a lot of that into retirement unless you have plans for that money now. And I said, you'll just save the taxes on it. So there's just a lot of things that can be done, especially after we get past 50. The retirement system is geared to help us, especially if you're in a big tax bracket. It really can have an impact on your retirement later in life.
Randy, another item on our list seems unrelated to retirement at first glance. It's organizing important documents. Why does that matter here midway through the year?
So many times, and I think this is true in almost every family, there is one person. In fact, I had this again yesterday. A guy sitting there, he says, well, she knows all the finances. I don't do that.
Okay.
So it's important that people know. And I've had it the other way where, well, he does all that. I've never looked at that.
I would say that's actually fairly common.
Yeah.
I mean, that's probably,
unfortunately,
I would say probably 1 out of every 3 couples that I meet, one person that really doesn't really know what's happening and one that's trusted to handle it. And I think every relationship's different, and I think there's a certain amount of that has to happen to maintain peace in a relationship. You know, if you have too many chefs in the kitchen,
yeah, I know what you mean.
But at the same time, I think it's good that everybody know where they stand if you're going to have your goals become the outcomes that you want them to be.
Even in my household, when the SpaceX IPO was coming out, and I thought, well, I'll put a little money in there. I'm talking to my wife, and I said, well, I think we should do this number. And she goes, oh, no, we need to do this number. I'm thinking, honey, that's pretty aggressive. And you're talking about somebody here that's not normally very aggressive.
Yeah.
So, but anyway, yeah, I mean, it's just that way. You need to have things written down, and people need to know where to go and who to see if something out of the ordinary happens to their spouse or their loved one.
Right. I call that a locator list. You can make it however you want, who to contact if something happens, but use your names and passwords, where the insurance policies are, just all the things that are important to someone who may be left behind. Many people tell us, Randy, that their budget feels a little tighter than it did about a year ago. What should retirees and pre-retirees do about that, if anything?
Yeah, well, I think number one, everybody's in the same boat, so you're not alone. That doesn't make it feel any better. You know, inflation has changed the math for a lot of households. I will say this, though. I've been watching Bank of America, U.S. Bank. They're saying that people still have a lot of money in savings, and people are doing quite well overall. But I think the thing that we could look at is, and I know this is true of me, I can sit down and think, this is kind of what I want to spend and where I need to be and what I want to save. And if I'm not careful, I drift away from that.
Mm-hmm.
And all of a sudden, that monthly membership's only $49 a month. So pretty soon we've got, $300 or $400 a month. And people say, that's pretty extreme. It just happens. So we use a program. There's Monarch, there's Rocket Money. I think Intuit has a couple of different programs that you can use. But we use some of those to help us kind of identify the things where we may slip out of our groove that we need to be.
Yeah.
And by just really knowing where you are, sometimes you go, well, you know what? I'm really not even enjoying that anymore. And I don't know why I'm even paying for that.
Yeah.
But the reality is things are going to cost more. But I will say this, for people that come in here, and we've seen a lot of this of late, and sometimes people say it's just not fair. Well, if you're invested or have something that's tied to the stock market, you've made a bunch of money the last few years. And actually, in the market, you have kept pace with inflation and maybe a little bit the other side. So investment is important. I'm not saying it's the be-all, end-all, and I'm not saying that I'm happy that inflation is probably running hotter than it should. But with oil prices coming down, as we have seen, we're going to see the inflation side come back down again. But really the thing is, I guess, once in a while, sit down, review what you're doing, look at what you're planning to do, look at your vehicles, look at just what you're spending on monthly subscriptions, and really figure out where you can save some money. And it's out there, and you can do it. I think that marketers have become increasingly good at getting in our pocketbooks.
Randy, this has been an interesting conversation. When we put this all together, what's the big takeaway here for our listeners?
Retirement isn't just about one big decision. Yes, it is a big decision to move into retirement, but then after that, it's just like life up to retirement. It's a series of smart investments and adjustments over time. The middle of the year is a great time to do this. I would encourage people, if you don't have a plan or you're not sure about your plan, you have questions about your plan, we are here to help you navigate through getting to retirement and through retirement by developing a plan that works for you and keeps you safe.
All right, Randy, I want to talk to the fine citizens here of the last bastion of sanity. Folks, one thing that Randy talked about today that really stood out to me, the most successful retirees don't wait until there's a problem to review their plan. They make the adjustments before the problems develop. If it's been a year, maybe several years since you've taken a serious look at your retirement strategy, now is the perfect time to do that here in the month of June. Call Floyd Financial Group today at 417-889-7233 and schedule your complimentary retirement review. You can do it today if you want, 417-889-7233. Leave your name and number. Ashley will call you back and set you up with an appointment to come in and sit down with Randy or Jake here at Floyd Financial Group. They'll help you evaluate your investments, your taxes, your income plan, your Medicare costs, and overall retirement readiness. Once again, it's 417-889-7233. No cost, no obligation, and no judgment. We'll meet you where you are. 417-889-7233. Also online at FloydFinancialGroup.com. Randy and Jake, it's time for a break. When we come back, we'll be talking about 2026's retirement rule changes, how they've shifted your savings when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to be talking about how the retirement rules have shifted for 2026.
And Randy, retirement planning seems to get more complicated every year. It feels like the rules are changing. What's the big story for retirees and pre-retirees here in 2026?
You know what I think? I think the biggest difference, really, Jeff, is the rate at which we continue to speed up information. I once remember my dad talking about my grandpa bought a farm over at Bradleyville, and he bought 325 acres for $12,000.
Wow.
And he had a 30-year plan as to how to pay for it when he went to the banker to buy it. So it used to be, too, that businesses could make really long-term plans. And it used to be a 5-year plan was a normal stepping stool for people now. I'm going to tell you, in business today, as fast as it goes, it's a 5-minute plan.
That's right.
But it is true. Things change so quickly. Companies that were viable can be wiped out, and companies that are viable are bought up and sucked up by another one. It's just crazy. And also, tax laws change, rules change about retirement and what you can do and when you have to take your RMDs, all the things that's happened. So in 2026 alone, you have different RMD rules that took effect for required minimum distribution. Medicare costs change, healthcare planning has changed. The exchange is more costly than ever. The Obamacare, the Affordable Care Act is now known as the Unaffordable Care Act. You just have to stay informed, and you have to stay on top of it all the time. It was once said that, this has been a few years ago, it said all the information in a USA Today was more than your granddad saw in a lifetime.
Yeah.
It's true. The rate at which we exchange information speeds up everything, and it's just really important that we stay on top of it.
Randy, let's talk about retirement savings here insofar as the year 2026 goes. What opportunities are available for people who are still working right now?
Yeah, for those people that are 50 and older, we kind of alluded to this earlier. Man, you've got good catch-up options.
Mm-hmm.
The standard maximum amount for a person under 50 to put into their 401k is up to $24,500. 50 and older get an extra $8,000, and you get another like $2,500 on top of that if you're 62, I think it is, and older now. So there's a lot of ways to put money away and catch up. Be sure you always are getting the match from your employer, whatever that is. Be sure you're putting that much in because free money is always good. But really, the ability to save more and tax defer it is great. I mean, it just has changed a lot of things.
And Randy, there is a big opportunity, and I'm not talking about Heinz here, but the super catch-up contribution. What is that for people 60 to 63? I always think super catch-up, that's the biggest bottle there, that Heinz. But
yeah, well, that's that deal I just alluded to. After age 50, you can do $32,500, but the 60 to 63 one is another $2,500 on top of that is what it is that you can put in. And again, people say, well, that's not very much, but here's the thing. When you look at how much that is over a 3 or 4 year period with growth and everything, it might be $150,000.
That sounds like a great opportunity, Randy. Is there anything that people need to watch out for, though?
Again, in 2026, higher income workers earning more than $150,000 a year will generally need to make their contributions on a Roth basis. Now, I don't know that that's necessarily 100% true, but every situation is different. But depending on what your situation is, tax planning looking forward, whether a Roth IRA or 401k makes sense for you, is something everybody needs to consider. Now, I will tell you this. If you're on here and you're 40 and under and you're a high-income earner or right at what I would call high income, if you're in the 24 to 32% tax bracket, this is a conversation we need to have that balances things maybe between a Roth and your 401k or a Roth 401k and a traditional. Everybody's situation is different. If you're 50 and older and you're trying to figure out how to sock away enough money to really generate income, even if you're in a pretty high tax bracket, you should really think about whether or not it makes sense for you to do a Roth conversion or look at doing a Roth 401k, because I'm going to tell you it does not always make sense.
Or even use a retirement account at all.
Yeah.
I think I get the pleasure of talking to some younger families, younger couples. And, if you're 30 years old listening to this show, you have to wait 29 and a half years to get to your retirement money. And in that situation, if you're 60 now, the ship has probably sailed as far as whether you get to do retirement money or not. But if you're 30, having some money that's not retirement money can afford opportunities for you to take advantage of things, business opportunities, houses, whatever it may be, that you really can't do in a traditional retirement account setting. So especially younger people listening, if that's you and you're really socking away some money, let's talk about what the best way to do that is. And there's even some more extreme examples of retirement accounts out there, 412Es, 412Is, where if you're making substantial income and you're willing to commit to funding it, you can fund potentially unlimited amounts of money into these. And we know one couple that put a couple of $1,000,000 in a retirement account over 5 years. Now, again, there's a lot of strings attached. It's got to be the right person. There's a lot of things that need to happen. It's not just like snapping your fingers, but the government funded, let's say, $700,000-800,000 into their retirement account for them. So that's something worth talking about too. So if you're trying to figure out what the best way to do all this is, that's what we're here for.
Talking with Randy and Jake of Floyd Financial Group, and we are talking about some retirement changes that you need to be aware of here for 2026. Our phone number, 417-889-7233. It's 417-889-7233. If you have questions or comments, or you just want to talk with somebody here at Floyd Financial Group about your retirement journey and how things have changed this year. Again, it's 417-889-7233. There is absolutely no cost and no obligation. We always talk about taxes and healthcare, gentlemen. Healthcare continues to be a major concern for retirees. What has changed this year as far as healthcare goes?
Well, we had a huge to-do, last fall and early this year about the healthcare subsidies.
Mm-hmm.
I was listening to a congressman the other day. He says, once you give a subsidy, when do you get to stop it? Almost never was the answer to that. And so when we pulled back what Joe Biden enhanced, people thought that we were jerking the rug out from under him. I mean, all we were doing was putting things back the way they were. What really needs to happen is we need a new plan, and I think everybody realizes we need a new plan because the Unaffordable Care Act is just not working. So I'm hopeful that we will see some of that maybe into next year. There's too many other fish to fry right now this year, and the midterms coming up and all that. But I think healthcare will resurface. But yes, it's definitely something that everybody has to consider. And I will tell you that there have been some really good non-insurance products out there for a long time now, where we're talking about organizations, a lot of them are Christian organizations,
Right.
and people that are able to, these are not insurance programs, but it's cost-sharing programs that have been around long enough and have great track records that people might want to consider.
Yeah, and I think there's one called MediShare or something like that. As you said, they're not insurance programs, but it's the Christian community helping each other with their medical bills, and I encourage people to check that out. What about Medicare? Are retirees seeing increases there as well this year?
The premium for Part B changes and goes up just about every year. I think it's about $210 is what it is now. It was as little as 140 some here recently over the last 4 or 5 years, but it's back up high now, and that's going to continue to go up. Costs are escalating. Healthcare costs are growing faster than almost anything, actually, which again is crazy to me. But yeah, so Medicare, you're having to have a little bit more cost sharing, but I will tell you that overall at the end of the day, Medicare is still a pretty good system, because if you have a supplement plan or an Advantage plan, the Advantage plans typically you don't pay any premium, but you pay copays for everything. The supplement side, you pay a premium each month, but you don't pay nearly as many copays. In fact, many times your out-of-pocket costs for hospital and doctors and things like that are almost zero. Prescription drugs you still pay for on both sides of that, but it's still a pretty great program overall.
Let's talk about taxes here. Of course, healthcare and taxes, two of the biggest expenses that we'll have in retirement. Here in 2026, certainly we did have some big changes as far as taxes go. And in the standard deduction, it is quite generous this year. Do we see it continuing to be quite generous next year?
So, we're at $32,200 if you're both 65 and older. And then your Social Security, you get an additional $6,000 a piece off that if you're under $150,000 a year gross income as a couple. So I'm telling you, the tax benefits for us retirees are pretty good right now. And I have to say that retirees, unless you're just making a ton of money, taxes are, what's a ton of money?
I don't know. I'm going to have to figure that out. I'll do the calculation here and see if I can figure it out while you're talking.
That's kind of like the term a buttload.
Oh, yeah.
Is actually a measurement term.
Well, it is. And there's different types of tons, too, but we're not getting into that one. Yeah, I know what you mean.
Yeah, the standard deduction for retirees right now is really quite high. With the Social Security exemptions we get, and of course, state of Missouri doesn't tax us on Social Security. That additional $12,000 against your federal if you're under $150,000 gross as a couple, plus your $32,200 standard. I mean, it's $45,000 that you get to take right off the top, and you stay in the 12% tax bracket up through $100,000 taxable. So today you can stay in the 12% tax bracket at the federal level at about $140,000+ a year. That's pretty solid.
And Randy, to your point about a ton of money, I understand that you guys have done little calculations there. How much is a ton of $20 bills?
$18,143,000.
Oh, gosh, that is some math right there.
Yeah.
Talking with Randy and Jake of Floyd Financial Group, we're talking about some changes here in 2026 that you might want to be aware of. A lot of our listeners, Randy, are charitable people. Have the rules changed there as well?
Well, yeah. I mean, used to be you could take charitable contributions above the line, and now you have to take them below the line, which basically says unless you're north of your standard marital deduction, you're not going to get any extra credit for that. Now, the one thing that you can do is if you're looking at taking your required minimum distributions and you're trying to figure out how to not pay taxes on that money before you give it away, you can do what's called a QCD. That's a qualified charitable distribution, and it doesn't even hit your tax return.
All right, Randy, if someone hasn't reviewed their retirement plan in a little while, what should they be doing right now?
Well, they should be calling us to review the retirement.
Okay. I set you up for that one.
You did, didn't you?
Yeah.
So anyway, I could not take the opportunity. But anyway, they should be reviewing. You should always be reviewing. Get on a regular basis to where you do it so that you can stay connected to what's going on in the economy and the world and with your money. And again, the every 6-month rule, I think, is probably a pretty good rule. There are some people, again, that have been with us a long time. They're every year, but for the most part, we're seeing people about every 6 months. If you have a lot of fixed investments, bonds and annuities, and not so much in the stock market, maybe an annual is the thing. But again, I think it's important to get on a regular schedule, stay connected to your money, your income, and what's going on with your retirement plan.
And remember these 3 letters, ABR, always be reviewing. Folks, if today's conversation taught us anything, it's that retirement planning isn't set it and forget it. The rules have changed here in 2026, and chances are your retirement strategy should be reviewed as well. So whether you're still working or not, we invite you to give us a call here at Floyd Financial Group and sit down. Let's talk about some of those changes and how they might affect you. 417-889-7233 is our telephone number. 417-889-7233. No cost, no obligation for this consultation. And of course, there is no judgment. We'll meet you where you are. Once again, 417-889-7233. Check us out on the web, if you will, at floydfinancialgroup.com. Randy and Jake, it is time for another break. When we come back, we'll be talking about a MYGA versus a CD mutual fund, money market funds, which belong in your portfolio, when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready to climb a mountain of financial know-how? Good, because it's time for more Show Me the Money with your financial Sherpas, Randy and Jake Floyd.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to be talking about, do we need a MYGA, a CD, a mutual fund, a money market fund? What in the world do we need in our portfolio?
Okay, Randy. One of the most common questions we hear from listeners is, where can I put money today and earn a decent return without taking a lot of risk? How do you answer that question, considering all the options that you just talked about?
Yeah, that is a great question, and we get that one all the time. So different investments are really designed to accomplish different things. So some are built for growth, which most times if they're built for growth, that means they're not as safe. Some are built for safety, which means that they're probably not as growth oriented. Some are built to produce income and may have some volatility attached to them. Some are liquid, some are more illiquid. And the key to building your retirement plan is understanding the role that each investment plays in setting everything up. So today, as interest rates have been higher and CDs were paying up in the 5% range, money markets were 5% for a while, Treasury bills, 10 years were at 5%. We even had 2-year Treasury bills at 5%. So today we're seeing a lot of interest in multi-year guaranteed annuities, MYGAs for short, because what they'll do is guarantee us an interest rate for a period of time. Now, most of the banks today, if you go and try to buy a CD, what we're seeing right now is they want to keep them at 9 months and less, because there's 2 places for banks to borrow money, either from you and me, Jeff, as the general public, in the form of a money market or a CD where they promise to pay us some interest, or they go to the Federal Reserve and borrow it from the government. And they don't want to get caught holding the bag if interest rates come down. That's why they're short term there. What we will learn is that looking at MYGAs, we can get longer terms at probably right now still a little bit higher rate than the banks are paying. So it looks very similar to a CD, but it's with an insurance company rather than a CD. Now, both have penalties for early withdrawal, and I will tell you that if you're going to use the MYGA, it will have a little stiffer penalty, but it will also pay you more right now. I can just tell you the rates are a little stronger than bank CDs.
Have MYGAs been around for a long period of time, or is it basically just a recent product?
MYGAs have been around as long as I've been in this business. Prior to that, I really can't speak to. I haven't done the research on it, but for at least 25 or 30 years, they have been around. I think it's just come a little bit more to the forefront than what it was, because for the longest time, when we look back over our shoulder through the 80s and some of the 90s, CDs paid 4% and 5%. Now, they were at 0 for a long time as well, nearly 0, 0.20, 0.5, 1. And then, of course, with the spike of interest rates with inflation back since COVID, we saw them back up there where they really made sense again. But for the most part, you're going to find out that what typically happens when interest rates react to whatever the Fed is doing, the CDs move up quicker than the annuity contracts. But when the opposite is true, where the Fed is lowering interest rates, the MYGAs tend to hold out much longer and have better rates.
Randy, let's talk about bonds, and I think bonds is the biggest investment class out there. A lot of retirees have always viewed bonds as the safe portion of their portfolio. Is that necessarily true?
Yeah, for a long time. Of course, the old retiree portfolio was the 60-40 plan, which is 60% stock, 40% bonds. The idea was that the bonds are going to pay you some interest, and they're going to be more stable than maybe the stock market being more volatile. And typically what happened years back, I mean, it used to be this way, just kind of straight up before we had a lot of newer financial products. It was kind of like, okay, here I am. I've got my money in stocks and bonds. And when the market started to falter, people would run to bonds. And when the market started to look good, they bail out of bonds. They were back and forth trying to always balance that thing out. But that has changed quite a lot over the last 25 or 30 years. So yes, bonds can still have and do still have a role to play in the modern retiree's portfolio. However, I will tell you that in some cases, there are bond portfolio options, such as fixed indexed annuities, that tend to really perform equal or maybe a little bit better than bonds over the long haul.
Randy, let's talk about mutual funds. They're a staple in a lot of people's retirement accounts. Can you explain what mutual funds are?
Yeah, that's a great question. Sometimes people say, well, this guy told me that these annuity contracts are really complex and can be really hard to understand. Most people know that a mutual fund at the 30,000-foot level it's a grouping of stocks or bonds put together, and there's managers that run it. But beyond that, they really don't understand much about them. And there's, as we alluded to this, I think the last time I was on this show, mutual funds out there. So why don't you explain those mutual funds to me, Jeff, right quick?
Yeah. Well, all I know is that there are a lot of things in a mutual fund. It's not just 5 or 10 different things. There are a lot of things in a mutual fund, aren't there?
Mutual funds are purposely opaque, meaning they don't want to tell you what's in it.
Okay.
Right? That's why they name it things like the large cap growth fund. Okay.
Yeah.
Jeff, do you know what the top 3 holdings are in a large cap growth fund?
I do not.
Right. And so neither does anybody else. Now, I mean, investors, people who are professional investors know that you're going to have NVIDIA and Amazon and Microsoft and all that kind of thing in there, right? But they purposely do that so that you're not thinking about what's in there. So you're not asking questions. And if you're not asking questions, they control everything. And so you've heard the saying that the game is rigged. Let me tell you how rigged the game is, okay? Like this perfect example recently with SpaceX IPO, right? If you're a billionaire, you have the ability to get in and buy SpaceX at $135 a share, where the average mom and pop just simply cannot. Mm-hmm. On a company like that, you're literally going to have to be at least probably $100 million net worth to really be able to pull strings to get pre-IPO shares. There's a few other ways to buy pre-IPO shares through funds and things like that, but you're not going to get pure shares. So when the stock then 2 days later is trading at 220, right, that person has already made 70% return on their money or something. And so the whole industry is built around keeping the public in the dark. And I kind of push back against that. I really like to explain things to people so that they understand many times for the first time in my office what they actually own. And I think that that's important if you're going to, how can you get to your goals to where you want to go if you have no roadmap, you have no idea what's in your portfolio and how it's going to react, what your investment advisor's thinking. I'm not saying that I'm going to feed you a lot of details that you don't want to know. I'm simply saying I will not pull the wool over your eyes. I will not purposely try to keep you in the dark because it's convenient for me and makes it less work for me. I want you to understand. I want you to have that moment, be like, oh, okay, now I understand how investing works. And I also understand how we're going to use eventual volatility, which we will have again, to our advantage.
I think there's one other thing that needs to be thrown in here too. I can't tell you the number of times that I've had people come in here. And let me just say this. One of the things you learn when you go to school to learn about investments and you go and you get licensed is that all investments have what's called systemic risk, just at different levels. They just do. And so people will come in and say, all my money's in mutual funds. It's safe. Well, it's as safe as the investments underneath it, which are generally stocks or bonds or something like that, which means, and everybody that's owned a mutual fund, if they would look back and really track it, they would see that their mutual funds have been down and they've been up and they've been down and they've been up. Many times it's kind of disguised early on because if you're funding your 401k, putting it into mutual funds, which today most of those are target dated funds, which are another set of issues, your money tends to keep growing because you're putting money in all the time, right? And so unless you have a pretty significant downturn, you don't really realize maybe what's happened. And the other thing, furthermore, is a lot of people don't look at their 401k statements very regularly. I've had people say, I haven't looked at my statement in a couple of years.
Yeah.
And I'm like, what? But again, it's this misconception that a mutual fund is a, quote, safe investment. And I'm not saying that diversity and the allocations of some of these are safer than being on a single stock. It is true. But there is systemic risk with a mutual fund.
Randy, it sounds like the real question isn't whether or not which investment is best. It's which investment is appropriate for a specific goal.
That's absolutely right. Or a specific client, because some people can stand the ups and downs of the markets, and other people say, if I lose more than $1, I'm going to come hunting for you. So, and there's everything in between. And that's why when we sit down and we talk to people, we want to get to know people, understand their goals, their dreams, their fears, what keeps them up at night, what helps them sleep. We want to know all those things because it's our goal to meet people where they are and give them a successful and as much as possible worry-free retirement. It's impossible to give you a totally worry-free retirement, but to really screw that down to where people can have a comfort level.
Talking with Randy and Jake of Floyd Financial Group, and we're talking about a variety of different investments, which include MYGAs and CDs and money markets and mutual funds. Our phone number, 417-889-7233. If you'd like to have your own private individual conversation about whether or not these options fit into your portfolio, no cost, no obligation, and no judgment, it is 417-889-7233. Randy, what mistakes do you see people make when evaluating all these options that we've talked about here today?
Yeah, I think that what happens is sometimes people get hung up on one investment. And of course, we have to talk about what is an actual investment. Well, an investment is not a CD, and an investment really isn't an annuity. An investment is a little different than that. But here's the thing. We all consider those things to be investments because we're looking for a return on our money and we're looking for somebody else to manage it. That's basically what an investment is, right? But I would say that as we look at all the different things that are out there, each investor has their own unique set of standards that they're trying to meet and things that make them comfortable. So as a team here, our goal is to make sure that we align our goals with yours and make you as much money as possible in the process.
All right, Randy, let's wrap it up by asking you the question, what's the big takeaway for our listeners today?
Yeah, the big takeaway is be diversified. Every tool has a purpose. CDs, money markets, bonds, ETFs in lieu of mutual funds.
Right.
MYGAs can be something that's out there. I mean, it's just a combination of everything. The key is understanding how everything works together and every tool has a purpose. And if we use the right tool for the proper purpose, guess what we get? The best outcome.
We've had a great conversation today here. Randy, want to talk to our listeners. One thing that Randy said today, I think that really resonates with me is the question isn't whether a CD mutual fund, a bond, a money market account, or an annuity is the best investment. The question is whether it's the right investment for your situation. You know, you've accumulated savings over the years, and now you're wondering how to position those dollars for retirement. Well, right now is the best time to get a second opinion on that. Call us here at Floyd Financial Group today at 417-889-7233 and schedule your complimentary retirement review at no cost, no obligation, no judgment. Once again, it's 417-889-7233. Don't try to build your retirement plan one product at a time. Build it with a strategy. Again, 417-889-7233. Make that call and schedule your complimentary review with Floyd Financial Group today. Well, Randy and Jake, it's been a wonderful show, but we're out of time for this week. So for Randy and Jake Floyd, I'm Jeff Shade, wishing you a great weekend. We'll talk to you again next week right here with another edition of Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.